It is February 2026, so we're going to go over a January market recap for Spokane real estate area for real estate and mortgages. And today we are at Pint House Burgers and Brews, the old good times right on the corner of Argonne and Mission.
Mission.
Yeah, yeah. So anyway, enough about us. Let's talk about some real estate. So we finished off the year a little over 400,000 for median sale price. So that was December 2025. To finish off January, we saw median sale price at 388,000. If you look year over year, it still shows us up 2%, but off, a bit from December of 2025. New sales were pretty much flat year over year. We saw inventory increase about 17% year over year. So January of 25 to January of 26. So that's pretty good. I mean, the silent, let's say modern reset that's happening right now, like if you're waiting for prices to drop, you're waiting for a ghost.
Well, and I would think we can say the same thing. I mean, kind of for the last 4 or 5 months, interest rates have been pretty much exactly the same. They're not deviating much, which is really good actually for buyers and sellers because you know what you're going to expect when you start to go out to look for a house as a buyer and as a seller. You know when the people are looking that their payments are going to stay the same as they were a week ago, versus when we had a lot of volatilities. In addition to that, I'm with the same thing with you on rates. I don't think rates are going to go down dramatically. I don't think so necessarily the next 3 to 5 years.
If we look like year over year, the mortgage payment, your average principal and interest payment is down over 7%. The interest rate, which January of 25, the average rate was 7%. That's down 12.5%. So you have 19.6% change to the positive if you're a buyer in the cost of owning a home. And rates are sitting 6.1, 6.2 right now on average.
Yeah, and I mean on average, and I don't necessarily think that Spokane's average, right? I think usually our rates are a little bit better than national average, and especially if you're looking at using some of the first-time homebuyer programs or FHA, VA, or USDA rural development programs. Those programs rates are solidly in the fives.
Yeah. Yeah, and the modern reset we're seeing right now is really a silent one. It's the first time in probably, gosh, I don't know, I mean, 5, 10 years, where what we're seeing the price of real estate stay relatively flat, maybe appreciate a little bit. Mortgage rates have come down substantially and staying pretty stubbornly like flat. So then for the first time in the last 5 years that I looked at, wage growth is outpacing the growth of real estate and it's outpacing the change in interest rates. So if
Well,
your wages go up by 5%, your cost of your owning your home just went down 5%.
well, as an example, today I wrote a new pre-approval letter for one of your agents that she just got a raise. It goes into effect in 2 weeks. It changed the house she could buy by about $25,000, right?
Yeah.
And now she's happy. She's made the offer. So I mean, not only is it hyperbole, it's actually happening where people now can say, okay, I can get the house that I want.
Yeah, and you're just not seeing it. Like the event of a crash, and so that's a 20% change in the real estate market. That's Phoenix, that's Vegas, that's you know Austin, Texas, that's Florida in 2008. Like that's a real estate crash. We don't have an excess of supply. Like I think it's like 4 out of 5 or 3 out of 5 sellers have an interest rate that's less than 3%. And so they're locking in.
Yeah.
To them, they're saying, well, I'm going to go from a $1,500 a month payment to a $3,000 a month payment unless I have to or I really, really want to. So we don't have the inventory that's going to drive down prices, but we still have demand. I mean, the reset, it's happening. You're just not seeing the headline.
I agree. I don't think in any major way our house price is going to change and interest rates are going to change. I literally think we'd be sitting here a year from now. House prices are going to be very similar. Interest rates are going to be very similar to what they are today.
And wages have gone up.
And wages will have gone up. I mean, then the one question I get all now is, now that Kevin Warsh has been not quite nominated, but about to be nominated to be the next Fed governor, what's that going to mean? Well, the current administration would like him to be a dove, but he's not a dove. He has not voted in the past when he was a voting member of the federal committee. He voted to raise interest rates. So I'm not sure that his appointment's going to change anything in the interest rate environment, let alone have any effect on mortgage interest rates.
Yeah, unpopular statement by me, but like I don't think it's a good thing if we lower, the federal funds rate. Like we can't have our cake and eat it too of saying like we want to have low inflation, we don't want to have 9% inflation. Nobody does, but like look at what caused 9% inflation. It was excessively low federal funds rate. It was, excess money being pumped into the economy. And so if we're talking like let's buy $200 billion worth of mortgages, let's lower rates aggressively, like that's not great stuff for keeping inflation low. I mean, it's going to do the exact opposite. I'm a fan of Kevin Warsh. Like I'm a fan of a hawkish Fed chairman, and I think it'll be good for the long term.
Well, and I don't think at the end of the day, let's be honest, $200 billion is not a lot of money when you're talking about mortgage-backed securities. The Federal Reserve Bank is probably rolling off 60 million a month,
Hmm.
right? That are rolling off their books and they're not reinvesting back into mortgage-backed securities. So
Yeah.
200 billion isn't going to absorb that much demand.
Yeah, at the end of the day, I mean, it's a you're going to make a move, whether it's selling or buying or investing because you have to or you want to. And if you're waiting on the sidelines for, this big crash or, something along those lines that you're going to see in a news headline, I really don't think it's happening.
Well, I
Um,
think so. And I think from a lending standpoint, one of the things that I'm starting to get a little bit more excited about is during COVID, both Fannie Mae and Freddie Mac made loan level price adjustments, but at the end of the day, they raised rates for second homes and for investment properties, discourage that purchase. Well, there are now private investors and private banks coming in to replace that don't have the loan level price adjustments, and rates will actually be much more competitive if you're looking to buy an investment property or buy a second home than they would have been even a year ago. So as it's investment banks continue to get creative because they want to do more loans, I think there's going to be better opportunities to purchase real estate this year than there probably was last year.
mhm. Yep. So all in all, I really do think 2026 is going to be a good year as far as activity. I wouldn't expect a ton of appreciation, and I would expect to see the trend continue to really like allow housing to be more affordable. Honestly, naturally, without a bunch of intervention and all that stuff. Like I think it's going to happen naturally, and that takes a little bit of time. It's not a one-time event kind of deal.
No, I agree.
So, well, as always, we can be reached at 509-990-SOLD or SpokaneHomeGuy.com.
And we can be reached at 509-747-1300 or chimneyrockmortgage.com.
And we'll see you for next month's episode.